Hey, welcome back. Had some questions about bonds and fixed income. And so what I wanted to do today was to spend just a little bit of time opening that up for us just to make sure that we're all on the same page. And I think the best way to look at the subject of bonds and fixed income is in light of all of our portfolios, which include a mix of stocks and bonds. Some have more a little bit more bonds than others. Some are almost all stocks, but the core of our group of people will have some of both. So if we look at these together, I think it helps to lay out what a bond is the best. So when we are owning stocks, and that's on the left on my slide, we are actually buying shares of the great companies of the world. We're an owner. Might be only fractional size owner, but we are a fractional owner of the great companies. When we buy a bond, we are actually technically lending money to the entity who's issuing the bond. If it's a company, we're lending money to a company. Apple, for example, has issued bonds, or to a government. And obviously our government and many others issue bonds. So the best way to think of a bond then is really a lot like the reverse of the way a mortgage works for us. So if you've had a mortgage in the past or you have one right now, you know how this works. You apply for the mortgage, you get approved, you're given a hunk of money that then you can buy a house with. Then you turn around and you are required to pay back principal and interest over a period of time. And that goes back to the institution who lent it to you. When we buy a bond, we are giving the hunk of money to the entity, say it's a U.S. government bond, and then what the U.S. government is on the hook for is to pay back interest on the bond and the principal on it when it matures. Now, to be sure, both stocks and bonds have volatility. Even though bonds have a lower degree of volatility than stocks, they have it. The way it works is when a bond is issued, let's just say it's a bond, it's a 1-year bond. Basically, during that year that bond is outstanding, the issuer of it has to pay back the principal in a year, but that same bond can be bought and sold every day between the time of purchase and the time it matures. And so the value of it can change every day. And we saw this emphasized last year in a significant way, in that we had both stocks and bonds going down for a period of time due to the fact that interest rates were rising. Bonds react negatively to rising interest rates. So that's why we saw that. Won't be a permanent condition, but it's been the condition and is likely to continue at least through some of this year. So we've just reemphasized we are long-term, goal-focused equity investors. We diversify within company stock holdings and within the different asset categories. So, for example, large companies, small companies, large overseas, small overseas, value, growth, emerging markets. Those are some of the main categories which we diversify within the great companies. And we further diversify by applying some bonds to that. So try to keep these short and tight. Tune in next time and we'll go over some of the results of what we've seen from stocks and bonds, which will lend itself to why we have established ourselves and our investment philosophy in the way that we have. Thanks for tuning in. Until next time, thank you.